Welcome to Talk Tickers. We're your summary for earnings calls.
That's right. And today, we're diving into Couchbase.
Yeah, their first quarter for fiscal year 2026. We'll unpack the numbers, what management said on the call.
And really try to understand what it means for the business, based purely on their commentary.
Okay, so what's the quick take, the headline?
Well, the big headline is they had a really strong start to the year. They actually reported results that beat the high end of their own guidance ranges.
Across the board.
Pretty much. Across ARR, that's annual recurring revenue, total revenue, and their non-GAAP operating loss. All better than guided.
Exceeding the high end right out of the gate. That's pretty good.
Yeah.
How did the CEO frame it?
He called it a great start specifically and really highlighted strong momentum as being key. Seems like they feel good about how they executed in Q1.
Okay, makes sense. Let's get into the snapshot then, the key numbers.
Sure. So total ARR, that measure of their predictable subscription revenue, it hit $252.1 million. That's up 21% compared to last year. Or 20% if you look at constant currency. Sequentially, it was up 6%.
And how did that compare to their guidance midpoint?
That's where it gets interesting. It was actually $7.7 million above the midpoint of their ARR guidance for the quarter.
Wow, $7.7 million beat on ARR guidance is definitely significant. But I think there was another ARR number that really stood out.
Oh, absolutely. The net new ARR. That's the increase just in this quarter from new business and expansions minus any losses.
Right.
That came in really strong at $14.2 million. Now get this, that's over 300% growth compared to Q1 last year.
300%.
Seriously.
Management made a point of saying this was their highest net new ARR for a first quarter ever, and the third highest quarter overall in their history.
Okay, so what drove that massive jump?
They said it was a combination of things. Healthy renewals, strong expansion deals with existing customers, really robust consumption.
Consumption meaning people actually using the platform. Exactly. Launching apps, scaling up, and a big contribution from Capella, their cloud database service.
Right, Capella. Let's dig into that. It's a huge strategic focus for them. How did Capella do?
It kept up its pretty impressive growth. Capella ARR grew over 80% year over year.
80%.
Yeah, hitting $44 million. So now Capella represents 17.4% of their total ARR.
And that's up from?
Up from 16.2% just last quarter, and a big jump from 11.5% a year ago. Sequentially, Capella ARR grew 14%.
And they mentioned consumption specifically within Capella.
They did. Called out strong credit consumption growth, which basically means customers aren't just signing up, they're actively using it, scaling up, migrating old apps, building new ones. That's a good sign.
Okay, so ARR looks fantastic. Capella's growing like crazy. But the total revenue number was a bit different, wasn't it?
It was, and that's a key point, something analysts definitely picked up on in the Q&A. Total revenue for Q1 was $56.5 million.
Which is up.
Up 10% year over year and 3% sequentially. So, decent growth, but not like that 21% ARR growth.
And software revenue specifically?
Software revenue was $54.8 million, up 12% year over year. But their professional services revenue actually declined quite a bit, down to $1.7 million. That's down 27% year over year.
Okay, right. So that gap between the ARR growth rate and the revenue growth rate, management had an explanation for that, right?
They did, and they spent some time on it. They were clear that ARR is the metric they prefer, the one they think best shows the underlying business health.
Makes sense.
The main reason for the difference, they said, is the ongoing shift, the migration of customers from their traditional on-premise enterprise licenses over to Capella.
Ah, the cloud transition effect.
Exactly. With the enterprise stuff, you often get more revenue recognized up front. Capella is usage-based, pay-as-you-go, essentially. So as customers move, there's this temporary dip or lag in reported revenue while they ramp up their usage on Capella.
Even though the underlying commitment, the ARR, is growing faster.
Precisely. And that drop in professional services revenue also plays a part in that gap. They did say they expect those growth rates, ARR and revenue, to start coming closer together next year as that Capella base gets bigger and matures.
Okay, that explanation tracks. There's a timing thing masking some of the underlying strength. What about profitability? How did they do there?
They showed improvement. The non-GAAP operating loss was $4.2 million. That's a 7.4% operating margin.
And non-GAAP just means excluding certain, one-off items.
Right, stock-based compensation, things like that, trying to get to the core operating picture. And that $4.2 million loss is better than the $6.7 million loss, or 13% margin they had a year ago.
So progress towards profitability, what drove the improvement?
Management pointed to operating leverage, basically getting more efficient as they scale, also better sales and marketing efficiency, and just keeping a tight rein on costs overall. They did mention a slight headwind from foreign exchange rates, but still definite improvement.
Good. So leverage, but still investing clearly, given the ARR growth. Did average customers spend more? Any other customer metrics?
Yep. ARR per customer actually increased. It's now $269,000, up from $257,000 last year.
Okay.
And their dollar-based net retention rate, NRR, that metric showing how much existing customers grew their spend over the year, it stayed strong, greater than 114%.
Greater than 114%. And they expect that to go up.
They do. They expect it to get back to their historical levels, which are usually over 115% later this fiscal year, probably in the second half.
Why the lag?
They explained it's because NRR is a trailing 12-month number, and it's still reflecting a specific kind of unusual downsell and customer loss they had back in Q2 of last fiscal year. Once that quarter drops out of the 12-month window, the NRR should tick back up.
Right. Makes sense. Okay. NRR solid, likely improving. But hang on, I thought the transcript mentioned the total customer count went down slightly. How does that fit?
Yeah, good catch. It did. They ended Q1 with 937 customers, which was a net decrease of 10 from the previous quarter.
So losing customers while ARR is booming seems odd.
It does on the surface, but they addressed it directly in the Q&A. They were pretty clear it wasn't an issue in their main customer base. The decline came specifically from churn in their lowest spend customer group.
The starter packs.
Exactly. Those bulk K to $50 K a year starter packs, they introduced those about a year ago. So many were up for their first renewal this quarter, and while some didn't renew. So that churn at the very low end offset the good retention they saw in their core higher value customers. They also mentioned that the Capella free tier is now what they're pushing for developers just starting out or doing proofs of concept. So maybe some of that initial exploration is shifting to the free tier instead of the small paid packs.
Okay, so segmenting the funnel. But did those starter packs actually work? Did they bring in customers who eventually spent more?
Management said absolutely yes. They gave specific examples on the call. Customers who started in that tiny IT to $5 K range and have since grown into really significant accounts.
Like how significant?
Several spending over $100 K ARR now. And get this, 2 that started there are now over $500 K ARR and apparently trending towards $1 million.
Wow. Okay, so even with some churn, the program did uncover some future whales. That validates it as a sort of top-of-funnel tool.
That's exactly how they framed it. Validated its value, even if it caused a small dip in the total customer count this one quarter.
Right. Okay, good context. What about the balance sheet? Cash position.
Looks solid. They ended Q1 with $141.8 million in cash and short-term investments. Said they remain well capitalized.
And RPO, remaining performance obligations.
RPO, basically the contracted revenue they expect in the future, was $239.6 million. That's up 9% year over year.
Okay.
The portion they expect to recognize as revenue in the next 12 months, sometimes called current RPO, that was $158.7 million. And that piece was up a stronger 16% year over year. They did note RPO can fluctuate quarter to quarter based on, when big deals renew and contract lengths.
And cash flow for the quarter.
Operating cash flow was negative $6.8 million. Free cash flow was negative $8.6 million. That's about a negative 15.3% free cash flow margin for Q1.
Okay. Let's shift gears a bit from the pure numbers.
Yeah.
What were the big strategic themes management kept hitting on? What's the bigger picture they painted on the call?
They really doubled down on their main strategy, being the go-to database for critical applications.
Critical apps, meaning?
High performance, always available, scalable things, stuff businesses really rely on. They said executing on this is what's driving their pipeline growth, especially for these bigger, more strategic deals.
And engaging with those strategic accounts.
Yeah, deepening those relationships is paying off.
Yeah.
Leading to strong upsells, strong expansion. You saw that directly in the huge net new ARR number. And Capella adoption, that was another constant theme.
Driven by migrations and new apps.
Both. Migrating existing stuff and building totally new applications on Capella, leading to what they called robust credit consumption. People are using it. And regarding the macro economy.
Yeah, what did they say about that? Still tough out there.
They acknowledged it. Said there's still pressure on sales cycles, deals getting scrutinized. But crucially, they felt their strong pipeline and their specific positioning around AI, future-ready apps, and the total cost of ownership, or TCO, benefits they offer. They felt that helped them kind of push through those macro headwinds in Q1, didn't seem to hurt their delivery this quarter.
Interesting. So their niche, their focus is maybe insulating them a bit.
Yeah.
What about how they're selling? Any changes to the go-to-market?
Sounds like refinements, mostly. A really disciplined focus on finding those critical application opportunities, and they've created dedicated teams just for strategic accounts to really nurture those big relationships.
Makes sense.
They also talked about making it easier to get started, mentioned the Capella free tier again, and those starter packs as ways to lower the barrier to entry. They see these as feeding the funnel for bigger deals down the road.
Any proof that's working?
Well, they highlighted one leading indicator,
Yeah.
a significant jump in trial volume compared to last year. They see that as a good sign for future demand.
Okay. And on the product side, innovation pace, keeping up, especially with AI.
Yeah, they stress they're maintaining a fast pace, launched something called Couchbase Edge Server in Q1.
Edge server for like devices and stuff.
Exactly. For offline first situations, think mobile apps, remote sensors where you need the app to work reliably even without a connection. And AI was a huge focus area they discussed.
What specifically are they doing in AI?
They talked about their vector database capabilities, which are crucial for many AI applications, especially these new AI agent type apps. And they launched something called the Model Context Protocol, or MCP server.
MCP server, what's that?
It basically helps AI agents interact directly and autonomously with data stored in Couchbase. Makes it easier, they said, to build complex generative AI apps on their platform while keeping things scalable, reliable, compliant. Plus, they mentioned expanding integrations with other tools.
Sounds like they're trying to position themselves right in the middle of the AI action. Did they share any customer stories? Wins that kind of illustrate all this?
They did. Gave quite a few examples. On the enterprise side, a big energy company using them for a nationwide loyalty app. A defense customer using them for frontline medical apps needing secure, real-time data. A global medical tech company for a critical cardiopulmonary mobile app.
Those sound like critical applications, all right.
Yeah.
Any specific Capella wins?
Yeah, a big one was a major North American pro sports organization, chose Capella for a real-time telemetry web app, apparently picked Couchbase over a big hyperscaler competitor.
Why? What was the deciding factor?
Performance, ease of use, and handling that high-velocity data for a mission-critical system. That was the reasoning given. They also highlighted more mobile wins, especially where their edge capabilities and offline sync were key differentiators, often replacing competitors.
Like what kind of mobile apps?
A healthcare provider's field agent app, a developer making real-time scoring apps for sports events, an industrial supply company modernizing their field service app, lots of mobile traction.
And those strategic accounts you mentioned, examples of expanding within them.
Yep. A global luxury brand expanding use for an in-store customer service mobile app. A big family travel and leisure company, enhancing a major theme park's mobile app. A cloud parking management company migrating to Capella for better performance and real-time sync.
Okay, those examples really show how they can get embedded and grow within big customers.
It definitely underscores that strategic platform idea they're pushing.
Now, what about competition? Analysts always ask about that. Did they mention competitors like Snowflake or, Postgres?
They did. It came up in the Q&A. Management kind of framed competitor moves like Snowflake buying a database company as just proving how important databases are becoming, especially for AI.
So validation.
Validation, yeah. But then they pivoted hard to differentiation. Their main point was, Couchbase is built for a specific type of application, those critical ones.
The high performance, high availability ones.
Exactly, where you need extreme performance, scale, low downtime, good PCO. They argue their whole architecture, memory first, integrated services, native vector stuff, gives them a real advantage there compared to solutions that might just add JSON or vector features onto a different foundation. They think they lead for the really demanding, mission-critical stuff.
So they feel competition is maybe stronger in less demanding segments.
That seemed to be the implication, yes. They're focused on winning where their specific strengths matter most.
Okay. And the AI agent workloads they talked about, is that actually driving revenue now, or is it more future potential?
Still early days on the revenue front for specific AI agent stuff. Management said they're actively positioning for it. Customers are experimenting. They're seeing engagement using the new vector and MCP features.
But not a big revenue driver yet.
Not yet. They see it more as a positive sign for future growth, perfectly aligned with where they see next-gen apps going.
And back to those strategic accounts for a second. When they land one, is it usually for one big project, or does it open the door for more?
That was a key point they made. These big strategic accounts often have tons of potential applications or microservices, they threw out numbers like tens, even hundreds that could use Couchbase.
So the goal is to become a platform.
Exactly. Become a strategic platform inside that company. Then you get this disproportionate expansion way beyond just the first app because Couchbase becomes a go-to choice for a whole category of their critical applications.
And that requires buy-in from both developers and management.
Right. Developers need to like the tech, the capabilities.
Right.
And leadership needs to see the TCO benefits, the strategic value. It's a top-down and bottom-up sell.
That really shows the potential leverage in landing those big accounts.
Mm-hmm.
Okay, crystal ball time. What guidance did they give for Q2 in the full year?
All right. For Q2, fiscal 26, they're guiding revenue between $54.4 million and $55.2 million. That's about 6% year-over-year growth at the midpoint.
Only 6%. That seems low compared to the ARR growth.
It does, but remember that lag effect from Capella migrations they talked about?
Yeah.
This guidance reflects that timing difference. ARR guidance for Q2 is much stronger. $255.8 million to $258.8 million.
Which is
20% year-over-year growth at the midpoint. So ARR still growing fast. Non-GAAP operating loss for Q2 is expected between negative $5.1 million and negative $4.1 million.
okay. And the full year, did they update that outlook?
They did. They actually raised their full year guidance for both revenue and AR.
Raised it. Okay.
Yep. Full fiscal year 26 revenue is now expected between $228.3 million and $232.3 million. That's about 10% growth year over year at the midpoint.
And full year AR.
Guided to $279.3 million to $284.3 million. That's 18% year over year growth at the midpoint. And they noted that ARR number includes about a $3.6 million tailwind from foreign currency.
And the operating loss for the full year.
They tightened and lowered that range too, now expecting a non-GAAP operating loss between negative $15.5 million and negative $10.5 million for the full year. That includes about a $3.5 million FX headwind on expenses, so the underlying improvement is even a bit better.
And did they recommit to their longer-term profitability goals?
Absolutely. Repeated their commitment to keep improving profitability through leverage and cost discipline. And importantly, reiterated their target to be both free cash flow positive and non-GAAP operating income positive in fiscal year 2027.
Okay, FY27 is the target for positive cash flow and operating income. Got it. That brings us nicely to our final segment.
Right. Time to put on our speculative hats.
Exactly. This is the part we call, this is not financial advice. It's purely an exercise, thinking about how someone might interpret the call, drawing only on what management said to form a potential trade idea.
And we have to stress, this is just talk based only on this one call. It's definitely not a recommendation.
Yeah.
It involves huge risks and isn't based on deep financial analysis. Purely a thought experiment based on the narrative.
Couldn't have said it better. So with that massive disclaimer, here's one potential idea sparked by this call. A straight long position in Couchbase, betting on shares outperforming over, say, the next 12 to 18 months.
Okay, what's the thesis behind that, based only on the call?
It comes directly from that ARR versus revenue gap discussion. The idea is that the market might be looking at the current, somewhat lower, reported revenue growth.
Which management says is artificially held back by that Capella migration timing lag.
Right, but underneath you have that strong 20% plus ARR growth, the record net new ARR, the talk of robust Capella consumption picking up.
So the bet is that as those migrations complete and the consumption really ramps, which management sounded confident about, the revenue growth will eventually start to catch up, maybe forcefully, to that higher ARR growth rate.
Yeah, maybe sometime next year. And that acceleration, that convergence, could potentially surprise the market if it's too focused on the current lagging revenue number. It assumes, of course, that the trends they highlighted in Q1 strategic account wins, Capella usage, continue strong.
Okay, that's one angle. Any others? Maybe something a bit more complex.
Well, you could think about a paired trade, maybe, long Couchbase, but shorting a competitor.
Hedging the bet a bit. Which competitor, theoretically?
Theoretically, one that's seen as strong in, let's say, general purpose data warehousing or analytics, but maybe less specialized in the kind of high performance critical application niche Couchbase is targeting.
Okay, and the rationale there, again, just from the call.
It leans heavily on management's differentiation points. Their confidence that Couchbase's architecture, memory first, edge, native vector, the whole package, gives them a real defensible edge for mission-critical apps and those emerging AI agent workloads.
So the bet is that this focus lets them win the really demanding high-value deals where maybe broader platforms struggle with performance or scale or offline needs.
Exactly. You're betting Couchbase carves out and wins in that specific high-value segment, especially as AI agent apps grow, potentially taking share or winning deals competitors can't handle as well, shorting the competitor hedges against, just the whole database market going down.
Got it. But again, super speculative, huge risks involved.
Absolutely. Purely hypothetical,
Yeah.
based only on interpreting the narrative from this one earnings call. Please, do your own research. This is absolutely not financial advice.
Definitely not. Okay, so let's wrap up this deep dive into Couchbase Q1.
Yeah, the bottom line seems to be a strong quarter, clearly beat their own expectations. Good momentum driven by that impressive ARR growth, wins in big strategic accounts, and Capella adoption really picking up steam, especially the consumption part.
We heard about the key dynamics, like that temporary cloud migration impact on revenue timing versus ARR, their focus on differentiating themselves for critical apps and AI, and how they're trying to build the top of their funnel with things like the free tier.
And they sound committed to growth, efficiency, and hitting those profitability goals for fiscal 2027 positive free cash flow and operating income.
And just one last reminder, this was our summary and interpretation of the earnings call content. It's not investment advice in any way.
Right. So here's a final thought for you to chew on as you digest all this. Management talked a lot about robust Capella consumption growth and that record net new ARR this quarter. The question is, how quickly could that momentum, the actual usage ramping up in these strategic accounts, start to pull the revenue growth rate up noticeably, maybe even faster than current guidance implies?
Yeah, that convergence timing between ARR and revenue driven by Capella consumption, that feels like the key thing to watch going forward.